now we're looking at a market that has had all the possible shocks. I mean, unless short of aliens invading, right, we've had everything that could possibly happen to an oil market, and it's just not looking likely that there's going to be another event that will cause a shock. So it's also decreasing the time you've got to run for the exit door. Hi again, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, here for another market episode with Martha, James and Vincent. So we're just going to dive straight in because there's plenty to talk about. So who's doing the summary?
Yeah, so it was a very strong performance in crude futures this week, with that price already up to $84 per barrel in Brent crude futures. So perhaps we are seeing this fabled summer demand finally coming into fruition. It's not a coincidence because Brent's structure has rallied as well in terms of the spreads, which indicates a recovery in both the physical and financial oil markets. So the physical market has seen a lot of strength, especially in the data Brent North Sea crude market. Some bull plays going on. Perhaps we think that physical players have weathered the previous weakness, weathered the stop outs, and they have been planning this bullish move for it's been a long time coming. This has also been supported by favourable market positioning, because the recent ICE CFTC data showed that the market prices have been driven by changes in short positioning. So a huge addition in shorts, and more recently, plenty of short covering flows, leaving speculative longs plenty of capacity to enter. So all of this may have materialized in the price action we're seeing recently, which has been a really bullish action for crude.
Yeah, a bit of a positioning story. I think we went over it in quite a lot of detail last week. I think you mentioned the physical market. I think that is the bit to focus on now, because to go from deep contango to like very constructive backwardation in Brent in particular it's indicative of the market dynamics and the structure we have. So how can that happen, right? And I think the one thing you need to remember when trading and trying to express views is that these contracts all have very precise methodologies that are linked to the physical market. So first and foremost, at the end of the day, it's about the loading programs that are associated with the settlement. So so another way of saying that is, the front Brent spread is 2 months forward, right? It's loading for 2 months forward. So when we had the expiry for Brent, it's always a key moment because you're testing the market essentially on that day. It settles to physical. So you're going to say, right, who actually wants these cargoes and who doesn't want these cargoes? And so if you've been testing backwardation for a while and it looks like you're going to go into contango, typically you'll see the structural move into contango or a big move in expiry. And the last expiry, it looked like that was happening. We went from like plus 30, plus 20 to plus 10 as we approached expiry. On the time spread, which is like equivalent to like a balanced physical diff. So like minus 10, minus 25. I think you might even got down to like minus 50, which is like really deep contango. And then suddenly we had Trade House buying all the way up, I think until plus 10. So they just consumed all these cargoes. And what would you like take from that? And remember, you're meant to look at these physical trade houses trading physical and saying that's indicative of the physical market. But if it's 2 months forward, then they are also taking a speculative, even though it's trading physical, it's speculative. Like they don't know what's going to happen themselves. So for a trade house to go in and buy 26 out of 27 available cargoes for WTI Midland on expiry, that is taking like an enormous gamble that when it comes to these cargoes being in the prompt and having to deal with real like refinery economics and demand, that the demand's going to be there and at the level that you bought it or higher. So it was a very like big gamble to do when everyone was selling, at the end of last month, and then we were starting to get this really strong downward momentum and sentiment was getting killed. And then suddenly this one trade house can, buy all these cargoes at relatively strong levels to what the market was expecting. And then fast forward 3 weeks later, and you've got other trade houses coming in and saying, actually, yeah, the demand is looking good 3 weeks later or better than it was priced a few weeks ago. And they're now getting on the bandwagon and suddenly we're driving higher. And that is like the very nature of how we trade. So it's so tempting to say it's supply and demand models and it comes back to prompt fundamentals. It really doesn't at all. In fact, there's never really a time where it links to prompt fundamentals, because that's too late, right? It's about where these trade houses, majors, and people are actually willing to exchange barrels, and how that ends up coming out in the wash later on that will dictate their future movements. So it's all very complicated, but I guess the main point I'm just taking from what you're saying is, last week it was about positioning. It was about, flipping on a sixpence to rallying. Now we're like, okay, so we had this positional shift and now the markets are higher. Can the physical market keep up? And it looks like it is. So that's pretty significant. So now we have to say we're kind of exactly back to where we were maybe 6 weeks ago, anticipating summer demand, looking quite healthy. And we're just restarting this story again with a more balanced positioning market, which is kind of weird to say, but and it might sound like we're repeating ourselves a little bit, but that's the very nature of it. So what about on like crude stocks in the US? Like, I think that's getting interesting again, because I think there was even talk about SPR releases again this morning.
Yeah, Amos Hochstein, Biden's top energy advisor, was emphasizing the importance of lowering petrol prices for American consumers. So mentioning the possibility of further SPR releases going into ahead of the election season. So there's mixed sentiment around it. I think one can analyze it as political posturing ahead of election season. Another one, otherwise traders would react as in thinking like, because the Biden administration, they want to refill the SPR, but they're also talking about releasing at the same time.
So swing production, government intervention, which is the same as OPEC really, right? They're saying that they can overproduce, they can underproduce. It's really the same thing that the US are doing. So it shouldn't be that surprising. When it suits them, they'll buy. When it doesn't suit them, they'll release. And the SPR might be low, but we are also in a very different environment we were when the SPR was built up, right? It's about it was about security, but the US produced so much of its own oil in extreme circumstances that US are going to be fine, even in foreign like wars, etc., in terms of actually supplying oil. So it's more used as a strategic weapon, like just like OPEC's variable production is. So that's not really a surprise, but I think it's kind of frustrated people, because they're explaining like the same way we get frustrated with OPEC. It's like, we're all about balancing the market, yet you respond all the time to price, and yet you always evidently protecting price levels, and it's always a bullish narrative, yet you're trying to balance the market. It's quite frustrating to hear that. Whereas with the US, it's frustrating because they always talking about like inflation, lower prices, but at the end of the day, it's quite obvious it's a battle in price against OPEC. So I think we just need to move away from the traditional, it's just about securing supply. Clearly the market has way too much oil in all regions. It's not about energy security anymore. It's about the price, and the price war that goes with like marginal barrel production. Go on.
Sorry.
No, please.
But the price in the pump in the US has been going down from when we said it a couple of weeks ago, and it's forecast to still keep going down until like past the 4th of July into summer driving season. And on top of that, wholesale gasoline selling prices have been dropping as well, which indicates that the price of the pump is going to continue going down as well. So it just seems like such a random time to be saying, let's lower gasoline prices for inflation.
Yeah.
I guess because people still say, but they were lower when Trump was in power. It's such an easy card for people to say, and everyone says it all of the time, people of that persuasion. And yeah, it is, but prices are lower than last year, this time of year, and it's just a completely incomparable world to compare to a Trump presidency with the actual pricing.
No, that's one thing. But remember, again, this is one for you, James, probably, when you calculate the inflation statistic that people are always, referring to oil prices generically being higher means higher inflation. They're using quite specific contracts to reflect that. Yeah, the thing with inflation, though, and like you're saying, like, okay, so is it retail at the pump? Is it what is the oil price? What is inflation inducing, especially like global inflation inducing? You can't just use like US retail gasoline. And I wonder if, I don't know the exact answer, but I seem to remember that the official CPI calculation, like 10% of it is energy based, of which I think they use benchmark contract prices. I might be wrong, but I think they even use crude from memory. So if they're using just like prompt crude prices and that goes up, $5-6, whatever, then they're going to be alarmed on an inflation basis, even if the retail's coming down, because that's lagging, right? So you might be saying, okay, retail prices are going down, but obviously it's a wholesaler's price that it's wholesalers plus the retail margin, right? So you've got the wholesaler's price from last month
and taxes and stuff,
and then you add all that stuff, and then that's the retail price. But if like ahead the price is going lower, it's quite easy to predict the retail should be going down. So I think they're probably just responding to an immediate move in WTI crude futures would be my guess.
Yeah, I just think for like the announcement from Amos saying, oh, we're going to be doing all we can for you guys, the American public.
Yeah.
Like, why even tell them that they're unhappy? Why not be like, look what we've done, isn't this super?
Yeah.
It just seems like a really weird angle to start the week at. But
yeah, no, I mean, I kind of don't know what to say really. It's just, I guess people not really in the oil market, talking about the oil market is essentially what it comes down to. And the stock situation. So it's an interesting one as well, because the visibility on kind of global stocks has always been led by the US stock market because it's the most transparent and most up-to-date data and regular data. But the way the data is consumed now, it's so variable. Like if you see a build and you see draws, it would just generally speak to demand or oversupply or whatever. But now it's like you have to factor in exports, you have to factor in freight, and it's more of an indication of European demand as well, not necessarily US. So when we talk about the summer driving season, will it follow through? Will we get this Q3 demand? It's actually quite hard to determine it from just the stock implied demand from stocks changes week on week now. But James, you've got something to say a bit on
I was going to say on the data on Friday, you had the US consumer sentiment, University of Michigan consumer sentiment collapsed to a 7-month low. Expected to come in at 72.1, came in at 65.6. That's a big miss.
Yeah.
And if consumers are disappointed, a downbeat, then demand expectations, rising season, I'd expect to come in lower.
Yeah. And what is that based on? The sentiment index?
Current conditions, financial conditions, future expectations. There's several different metrics. Time for buying.
But it's actually forward-looking.
Yes.
Well, that's important. Yeah. And do you think that's was it a 7-year low? Did you say?
A 7-month low.
Sorry, 7-month low.
But it's a sharp turnaround. We have the chart to go up on the screen. A big turnaround, and the data across the US was weaker last week. The jobless claims suddenly jumped. Continuing claims suddenly jumped. And also the CPI came in lower as well. CPI and PPI. CPI both came in lower than expectations, 3.3%. PPI actually fell month on month, 0.2%.
Okay. I mean, you've been quite gloomy for the last couple of months, so I guess it's just more of the same, really. More evidence that that's the case.
It is. If you look at the economic surprise index, the economic data is coming in sharply lower than expected from the economists.
Like consistently. Yes, it's because I wouldn't have, this my generic, like looking at what people are saying and what you're reading, it doesn't feel like anyone's expecting. Well, I guess that's what you're saying.
Well, the economy's still ticking along. We're not, the recession's not weeks away, but the data continues to deteriorate. And the one outlier really last week was the Federal Reserve came out more hawkish than expected. So even having said that, they're not unanimous in what they're thinking. 2 Fed members are expecting not to need to hike this year. So not to need to cut. 7 are looking for 1 cut and 8 are looking for 2 cuts. But the bond market by the end of the week was pricing 2 cuts.
Well, definitely from what bringing back to oil, like definitely if we do get a strong rally into summer, it's like it's at massive odds with if it already, the sentiment's not looking so strong from a consumer basis, the price relatively high basis, right? And that keeps increasing into summer. I think that's really on a, what do you call it? It's like on the balance, right? As in like any higher and you're kind of inflation inducing by definition because you're not getting the demand at the current price it is now. And so any demand that is there is going to have to pay a considerably higher price. That's just going to eat, it's just going to be a catalog of things. So I can understand why there's a lot of sensitivity around it. And I think in general, I know we've kind of said it's flipped back and it's looking really constructive, but I kind of agree. We went from being constructive to, look, we can't deny all the bearish moves anymore, the bearish sentiment, the bearish data, to right back again. It gives me that sense of dead cat bounce. I think you kind of agree, right? And it's a bit...
Absolutely. Yeah. And the other one is China. The data coming out of China, retail sales came in stronger than expected, but industrial production was lower than expected.
Yeah.
But what stood out more, property prices had their largest monthly fall in 13 years, and M1 money supply had its largest drop since January 2000, down 4.5% year on year. So that we're not seeing signs of a strong recovery out of China either. So where's the expected increase in demand for oil? Where's that actually going to come from? It's only the Indian economy of the 10 largest economies in the world. It's only the Indian economy that's really booming.
And your Macro Monday is quite popular now. You had Harry on it yesterday,
Yes.
and you had a research. Was he echoing what you were saying?
Absolutely. Where is the estimated increase in demand for oil this year? Where's that actually going to come from?
Okay. And Vincent as well, just to plug you did a webinar as well, right?
Yes.
And you had, what was your argument there, just in a nutshell?
So yeah, in the webinar last week, I discussed that our view for crude, our crude oil market outlook was more of a bearish one going into the end of the year. So that also included weaker macro indicators. So that's out of the US, weak ISM, manufacturing PMI data. It's been contractionary recently, which has likely also contributed to weakening distillates demand out of the US. But also at the time, the physical market sentiment was weak. We acknowledge that, which was on the back of weakening gasoline and diesel cracks. Of course, the gasoline has continued to weaken as well, which, from a refinery margins perspective, that wouldn't lead to too much demand for crude in the coming months.
Okay. And then Martha, so you're doing the refinery margin summary, right? So where is that narrative leading?
I mean, it's pretty flat at the moment. Like looking at the week-on-week, day-on-day change, I think it's about 40-cent decrease in the week from the physical data crude being stronger and the products being stronger as well. You say stronger, they're like flat price, gasoline flat price I think has increased, but the cracks, the spreads, everything is seeing like a massive sell-off continually in the past 2 weeks. It's just been loads and loads of stop outs in the European market. So people that have been long stopping out, and it just kind of creates this snowball effect of it going down and down. You can tell in the prices, and we're kind of getting to the point now as to seeing how much more we have to see, how much more selling we have to see before the market's balanced. I think we've seen I think we've mentioned before, selling in the gasoline naphtha differential, which of course is another bearish thing for European gasoline. But I mean, looking to the States, the rubber's not been very stable in the past few days, but players are just so hands-off in the US and in Europe. They've been burnt, as we've said a few times. The gasoline market was so getting ahead of itself, and then just has had these really unexpected sell-offs, and has just not been moving in the like nice seasonal way that people expect, that S&D guys like expect. And I think that that's been really jarring for people. Where is the demand? There's 95% utilization of refineries in the States. It has been this high before, like this time last year, so it's not crazy, but the capacity has increased a little with like how much crude they're taking into the refineries. So, I mean, stocks are up, the price of the pump is down, and it just is, I'm struggling to find anything. I feel like you just have to wait until prices get low enough to stimulate demand, really. Yeah. But it's not looking great.
So this bounce back again, we'll put down to positioning in the outright price. It's quite a clear story. The Brent longs very, very low, lowest since 2020. Shorts getting too short. And that's a bit of a binary reaction. I almost think it was self-fulfilling. And I think we mentioned this last week as well. Everyone saw the data, goes, oh, well, you got to buy on that type thing, rather than necessarily it actually being initiated by, a short squeeze. It was kind of reactionary, which shows you that, as important as the EIA stats now are the CFTC positioning stats, and hopefully in time Onyx's positioning stats, right? If it's indicative of the wider market, then everyone just needs to take their line in the sand from these data sources and react accordingly. But I think what is also really telling is, like, I think you just like said it in a really nice way. It's jarring. It's like, I think people, traders, even analysts can accept irrationality of markets as a function of, that's markets for you, that's human psychology. But when it's so clearly like the intervention and the situation you've got where repricing signals are all over the place, and actually the market was trying to price that in, right? The market was getting short on the managed money side, positioning was decreasing, the physical was weakening, sentiment was going with it, all aligning to the macro indicators. That's what you expect over time, right? You can have dislocations, and the cure for high prices is high prices. Demand weakens and eventually it kind of uncouples. But to get goes from uncoupling to in line and reprices. But as we were starting to get that to then bounce straight back up, and to then having to be struggling around saying, where's the demand going to come from? Are we going to see this? Are we going to see that? And it not being followed up through the data, you just have to wait. And must be very frustrating for traders in seats, right? Who trade fundamentally, especially.
Yeah. And I think with the summertime driving story, there's not an easy answer to why people aren't, driving, other than one that's really kind of bleak, is that no one's got any money. And I mean, there's the work from home aspect, so people drive less. There's the not having any money. There's the people not being able to go on holiday, and also the electric vehicle aspect, which, depending on who you ask, will have a different impact. But I think so many of these things, you need to look at like the lagged indicators, I guess, for employment and working from home stats. And people can't kind of build them into their balances how they want to, and everyone's just really hands off in that kind of way.
Well, especially if you're not getting the feedback from the market that it's responding to fundamental signals anymore. And it went from fundamentals, like I would say, driving things very succinctly in times past in the market, to it being more financialized and therefore more overextensions. But I would say now, like fast forward all the way, 30, 40 years after the financial oil market was created. And it's a kind of like plethora of mess, basically, of algorithms and people's sentiments and intervention and swing production from OPEC, and then the US government, and then sanctions and wars, and it all kind of coming together into one like soup of positioning that doesn't know what it wants to do. In the meanwhile, as I say, having kind of shock interruptions that I would say are not allowing for, you expect these things, but you expect, a boom and bust cycle again, which is kind of a characteristic of the oil market. And we really need to reprice, because it's just jarring, like Martha says really well. And it means that the market can't function. And I don't know, people who aren't in the oil market, or boohoo for oil traders, they're not having a great time. But but it is just, for a well-functioning market, you want predictability, and even governments want predictability. Like at the end of the day, if prices are going to rise, then people want to respond to that. Governments want to respond to that. Countries want to respond to that. If prices are going to decrease, then vice versa. But to just get in the way, intervene, all for, delaying the inevitable is I guess quite frustrating. Now, James, you got the most experience here. When we talk about, I guess I am talking about a bubble, but it's also like not a bubble, because it's like things are propped up, say from an OPEC point of view. It's real physical intervention. It's not like it's people getting away in their heads, right? It's kind of real, if you like.
Yep.
When you see these things, these big repricings I'm talking about, these bust cycles, a lot of people make money from that, of course, but they tend to be the people who are contrarian, and they have to wait a hell of a long time. In your experience, is it very common just before this bust to have very difficult market conditions?
Absolutely. And it's very hard, as you say, to be a contrarian. If you look at the equity markets, the classic, it goes up for years and years. And when it falls very hard and very quickly. And if you're not on it, you typically miss it.
But in the meantime, what I'm saying is in the moment's price, it's easy to say after it's happened, because you had the view and it happened. But the leading up to it, you get all sorts of irrationality and difficult market conditions. And if you really are so convinced, you just have to wait, right? It's just timing.
It's funny, I was talking about exactly that this morning with Chris, the head of performance, about it's funny enough, my biggest loss as trading was just before the financial crisis. We could see exactly what was happening, but the market just took so long to react. And the equity market, the S&P fell about 8%, and we could see it starting to unfold, the financial crisis. And then a headline just came across by the Fed saying Federal Reserve monitoring the situation, ready to act if necessary. To us, that was a green light that the Fed have see there's a problem. But the equity market saw it as the Fed's going to cut rates, so the equity market went to all-time highs. And it took another few months before actually the global economy, the wheels began to fall off.
So that seems very similar today. That's short-term versus long-term money flows at odds with each other, right? Short-term indicators, especially even more so now with algorithmic trading and systematic trading. is responsive to headlines and then momentum. And so you can just have nonsensical moves for quite some time. I guess that's what we're putting the blame on for difficult market conditions.
If you look at the yield curve as well, the 2-year bond yield, it's getting into a narrower and narrower price range.
Yeah.
And typically that happens before a breakout either way. But you see the data, people were talking about a hike just 2 months ago.
Yeah.
And now it's when are the Fed going to start cutting? But no one's really talking about it. People are still talking about a soft landing. I don't remember the last time we had a soft landing.
Yeah, death of volatility is my experience of a impending move, and it can last quite some time. So we've been talking a lot about how volatility should be high this year, and it's been the opposite, right? It's been getting compressed more and more and more.
I was going to mention earlier, actually, we're talking about these moves in oil, but if you look at the bigger picture, there's no volatility there.
Well, I wouldn't even say these oil moves are huge. It's just when we looked like we were going to start getting a repricing, we didn't bounce back. It's still within a narrow range, to your point. It's frustratingly low volatility. But as you said, the bands get weaker and weaker, well, smaller and smaller and smaller. The justifications for being held up get weaker and weaker and weaker. And eventually you do give way. Massively talking a bearish game here, but it just that's how it feels, because
also you have to be very brave to short oil with the Houthi rebels, with OPEC, Russia, Ukraine, Israel, Iran. All the narrative we've gone on about for months is still there in the background.
Well, if you're from like when I started trading 2012 to 2013 to 2021, that's a good 8 years of bearish markets. So I grew up on bearish markets, don't have a problem selling markets. But then actually, if you've started markets kind of 2020 onwards, you've only seen bullish markets. And that's put people saying that at the moment, like particularly senior traders who weren't senior 4 years ago.
That's exactly the same with the equity market. Everyone wants to buy it right now. If you look at the long-term valuations, it's so expensive, but people only know bullish equity markets.
I mean, this is the thing. It's the thing about big moves, right? Like it almost by definition has to be what people aren't expecting for it to be a huge move. Otherwise, it wouldn't be a huge move, right? So everyone expecting recession last year, it never happened because so many people were starting to price it in. And with oil markets, I think it's probably the same thing. Everyone expecting a Q3 summer, everyone bullish, and there not being like many reasons as the year goes on for it to be that case. And then you get extreme positioning one way or the other, and only then do you get a move. So it's just a characteristic. And I think to your point about, so I just want to go back to you saying shorting oil, you need to be brave. There is a cure for that though, which is the best money made on a lowering volatility market and kind of an unaware market at a high price. 2018 was a good example. 2013, 2014 was a big one as well. You buy puts, out the money puts, because you do get the volatility explosion, and you get paid for that in buying the puts, and you get obviously the price decrease. So that's the cure to that. It's not that hard to backdraw.
Buy volatility.
Buy volatility and buy downside. Yeah, and because it's cheap, because it's so out the money. Like the thing about oil is like, obviously from a mathematical point of view, you get paid. Sorry, it's cheap to own out the money options because the standard deviations are like, you're outside of the bounds of standard deviation if you're buying a 50 put in an $84 Brent market. But if you just look at the cycles, 80 down to 50 is like very normal, like over the years. So it's just, I feel like it's something that's always a great risk reward in environments like this.
If you look at behavioral finance as well, one bias that we typically all hit by is recency bias. So we look at oil and we think, well, the recent range is Brent sort of 75 to 88, and we assume that's going to be the range. Excuse me, that's going to be the range going forward.
Yeah,
and at some point it breaks, and there's a huge level at 72 in Brent, where it keeps. I think over the last 18 months, it's got down to 72 and bounced 4 or 5 times. If it's to close below there, you'd see lots of stops get triggered. And
you remember this last year, I think even the year before, we were talking about this quite a lot about if you kick the can down the road with OPEC side of things, it's a bit like quantitative easing, right? Or it's like you're borrowing from the future for you right now, and eventually you get more and more and more squeeze. It's just taken so many years for it to happen, but you must have seen even for yourselves in the last few years, it does look like the market's going to reprice, but it's bounced back up with either OPEC headlines and increasing OPEC intervention, which we didn't think was possible. But even you must see, like, Well, yeah, what are your thoughts on that? You see what I'm saying?
I think it lends well to the OPEC's demand projections for 2024, and that compared to the IEA's, because their current voluntary cuts amount to 2.2 million barrels per day, which they're looking to unwind perhaps earliest beginning of Q4. And their demand projection is 2.25 as opposed to the IEA's or other bank forecast, which is around the range of like 1 to 1.5 million. So theirs is OPEC's estimates a bit more extreme. So they're essentially predicting strong demand growth, which would kind of like balance out their forecast and therefore keep holding prices up.
It's a bit like governments relying on inflation to erode debt. It's the same kind of thing, but you almost need to induce that inflation for it to happen on the government side. But on the oil side, you can't induce a strong economy. So I kind of get it, but I kind of don't. I just think like it's just kicking the can down the road again. But over the years, I guess I'm just saying, I've just thought this is getting tighter and tighter, harder and harder to keep up. Yet they always surprise me, just go deeper and deeper and deeper. But when you get so many signals, as we're saying, eventually, and you want everyone to not expect it for the move to actually happen. Did you want to say anything on that, Martha? Have you got any thoughts, just to bring you in?
I think when you say kicking the can down the road, I guess with the OPEC cuts, they were kind of like chasing this dragon of prices going to 100, like everyone was saying. And they've kind of admitted that they're not going to reach that. And I don't think that's really been, like, as Vincent said with the IEA price prediction, that this is all going to have to come back. Like when we look at the Brent, like for futures every week for forecasting, I struggle to find anything bullish in the market other than the positioning that Vincent mentioned earlier from the CFTC, which is hard to go by because it's looking at the whole curve. It's not just looking at the front. You're not looking at the kind of minutiae of who's doing what in any real, like, it's too vague. So it's hard to kind of take anything with that much value from it. And it's so in the past as well. Anyway, but it's good for like overall structure where you can see that it was really saturated short the other day. But I mean, apart from the saturation, I think it's like they're grappling to find anything bullish right now. Gasoline is rubbish. Diesel has rallied a bit this week, but it's still quite high relatively. And just going back to what you said about the like recency bias, I think we are seeing that a lot in gas oil and gasoline as well. Like how you always say these are such high levels in the gas oil crack. Even when they've been so low, we're seeing them supported now from buying because they look cheap, when in reality they're not that cheap. And then looking at Onyx Plug, looking at the Onyx Hub Flux, you can see seasonality charts now, which we're developing. What, they're beta? I don't know. This is the EBOB month one EBOB crack. The white line is this year, and it is very low compared to the past 2 years. But there was obviously extraordinary things happening then, and that comparing it to the years prior, like it's still high. So I think this is such a good example of recency bias. Be interesting to look at that for other products too.
No, really well said. And I guess this is hard to do when you've only been studying markets for 2 months. That's why it's impressive. I basically completely agree. But I guess, yeah, the issue is we're trading, you know, at the end of the day, is in like we're trying to talk about trading it rather than just talking about what should happen. And that's what sparks the debate. And that's what makes it interesting. But I just love the way you put jarring, because that is how to define it. Like, for fuck's sake, like what, like, you know, something makes sense, because you almost want to be wrong as well, because if you're wrong and the price, let's say you're bullish and the price dumps, you're like, okay, at least I know I'm wrong exciting. And I stop out. Well, it's not so much, it's like an acceptance of like, there's nothing worse than buying. It was actually one of my last, like when I was full-time trading, one of the last things, the market was pissing me off, kind of as it tends to, like over time, the more and more you fight like a losing position. And I remember I was like expecting a bullish environment, and at one point I was basically like buying as it was going up, like waiting for the momentum of the market, and then right, here it comes, okay, so start buying into it, believing the conviction, and then it would just dump. Then I'm like, okay, I kept getting caught on that, so I was like, you know what, I'm going to play from the short side. It's short, and then it would rally, and then you're just like, this. I'm going on. No, but I'm joking. But it's in like that's common for a trader, right, James? It's in like it can drive you nuts sometimes. But you're looking. What I'm saying is you're looking for the market sometimes to give you feedback, because you can't see it. You're like, you know, when I have a view and it plans out, you know, it feels like almost like a symphony, right? But like when it doesn't, you're like, I clearly don't know what's going on. I can't make sense of it. So I need to let the market give me the feedback and respond to that. But when even that's not working, it's time to just stop trading and like take a step back, right?
One thing I found with this market, oil particularly, is people get very rigid in their views. They're either long or they're short. Or they generally, I see people are long and they're very rigid with it. But the only thing at the end of the day, the arbiter of your P&L is the price action. If it keeps grinding lower and lower, it's telling you. But people have a view, and it's very hard to change your view.
Well, on that note, so I think what we also need to acknowledge is we got very variant price positioning on Brent. Going real extremes, and yet, even though it was kind of not expected, these kind of price pullbacks, which, as you said, very tight range. How can that be with such extreme changes in positioning? We need to factor in like the managed money. It's almost talked about too much, given too much weighting, because they are like fast money in and out, but you're looking at what the net impact is on the market from going all the way long to all the way short. And it's not a big deal as in terms of price range. So someone's on the other side of these, keeping the volatility kind of capped. And I think you have to say that's the physical traders, that's the majors, that's the trade houses, that's the hedgers. The flow coming from the banks, the flow coming from physical hedging. And it's just, we have to acknowledge that, like, if the managed money is getting whipped around and yet volatility is low, then actually there is a stubborn underlying view here, if it's speculative, or at least stubborn underlying flow that is on the upside, which is contributing to this stagnant. As you say, if it's going to reprice, I think, just wanted to add before you say it, like, they are forced to work that way because they as in like the big oil companies, they have to have, or they do want to have huge positions. That's how they get the big returns in a year. So it's like an oil tanker, like, excuse the pun, but it's like, well, how am I meant to just go and flip flop fast money when I've got 100,000 lots on, like 100 million barrel position? I'm not just going to get short one day and long the next. The market can't take it. So I need to be stubborn with my view and ride out the volatility and then capture it once a year is kind of the thinking. So I think that's where that comes from. And as you're saying, like, okay, the market's stubbornly bullish right now, all these indicators, but it takes quite a lot for them to turn this tanker around, because they need to believe that once they sell, the market can actually take the volume and then they can get short at a reasonable price before prices fall again. So there's no point selling 84 down to like 75 to get your liquidity off on the sell side, particularly as there's no buyers, and then 75 down to 68 just to get net short. Then you got expected to go from 68 to 40 to actually make any money and then liquidate theirs. You see the problem with being like not stubborn, if you see what I mean.
What interests me is the side of the managed money. If they're long, what's going to trigger their stop? At what level do they have to get out?
But that's it. It's like the exit strategy is always the hardest one. I don't know if you found this. Like stops, you can be very like methodical with it. Volatility stops, trailing stops, these kind of things. But exits, when you're in the money, is actually the hardest thing, because it's like, how do you determine what your expected value is? And obviously, you just want more and more and more, don't you?
If you get out too early, you kick yourself. If you get out too late, you kick yourself. So
right. So being systematic on the way out is probably as much of an edge as being strict with your stops. But to that point, it's diminishing returns as well, though. So if you're bullish right now, are you really expecting $140 oil? We didn't get $140 oil in the peak war and max OPEC cut we've ever had. I mean, that is, if you don't get the oil price then, how are you expecting it now?
An economy that was booming and people just spending coming out of lockdown.
Right. So what is your upside and what is the potential downside? It's not skewed at all. And then you add CTAs, right? We have talked about that. But again, we did talk about the shift of CTAs going from long to flat to then net short would be a big impact. But yet it didn't have that big of an impact. So I just kind of repeat that because I think that's quite interesting.
Yeah, I think it was big in the terms of what's happened in the past like 2 months. But I think like seeing, if you look at it on the graph with the CTA model that we have, we can put it up, like the huge drop from like high net positives to like pretty low net negatives, like so that shows that the all positioning volume can't all be CTAs either, or else it would have been huge.
So CTAs, they'd be just exacerbating price movements.
But it didn't know, on the way. What you're saying.
Yeah, so it'd be like counterflow.
That's what.
My point was that overall, I guess in the past 18 months, like crude prices have typically been pretty range bound between 70 to 90. Mm-hmm. So on the grand scheme of things, it's relatively not so volatile. Mm-hmm. So hence we've been seeing like a lot of funds, a lot of money managers, they've been going into the more niche markets, niche swaps markets, or
do you know what? That's actually a good point. So I think I'll add to that. So you've got managed money, and then you've got CTAs, and you've got algorithms, short-term money, that kind of stuff. Even more ETFs, which are long only. But you're right, there's a big rise in hedge funds this year. So separating out, I guess it's the real managed money because they do manage money, but let's just say systematic algorithmic risk parity, ETFs, all long only essentially, and then CTAs kind of jumping on moves. There's a new category this year, I would say, that you have to add, which is basically another layer of volume from pure discretion, which is just basically oil traders coming from physical shops, the BPs, the Trafiguras, the VTOLs. They go to a hedge fund, which is purely financial trading, and they're going purely off speculation and on an entirely discretion basis. And what they're doing is they're taking the logic from what they had at these physical houses and just applying it in the open financial market. The thing with that is you're replicating existing positions that are already in the market and existing logic, and you're just adding like speculative froth money on top of that. So I think that probably what adds to the propped up nature of the market, because you have traditionally a managed money, risk parity, all these things reacting to either signals or macro. These guys are reacting to underlying S&D. They pick up the energy aspects of subscription, the ship tracking subscription, and they talk at the conferences and they all get a consensus and they say, okay, we're bullish. So if my mates at BP and where I was at, these traders in Mayhouse, they're still bullish and I think it's bullish and I can see the S&D, we're all going to be bullish together. It's more of an impact this time on the propped up side because the new hedge fund money that came in trying to chase the returns that were made kind of 2020 to 2022. So they come in, they do what they know is just relying on S&D, but you've just added, do you see what I mean? You just added a layer of it.
And doesn't that come back to what we were saying earlier? It just means there's a bigger position waiting to blow when the price action, whichever way it goes, up or down, when it starts to move aggressively, then it's going to be even more aggressive move because it's the volatility of the recent price action is getting narrower and narrower, but also the size of the position that needs to unwind if it goes against them is bigger.
Unwinding says the key thing. So how do you do that? Knowing this, so you're at a big trading house, and you've got a huge position. You need the liquidity on the exit before you get short. And we've seen this in big moments in time, and actually geopolitical events. It's interesting you just said earlier, the risk of Russia, Ukraine, the whatever it might be, Houthi rebels, that kind of thing. But the physical industry, I'm not saying they don't care about these things, but they're not going to trade a physical view based on Houthi rebels because
headlines, you can't trade headline risk.
It's not S&D. Talking about the ship tanker analogy, that's not going to get in the way of the ship, right? That's just a microcosm. So that's more of a macro money move. So then, because you have macro money, fast money that reacts so violently or so quickly to geopolitical events that they don't think is a long-term sustained impact, you tend to get on big headlines liquidation actually of these positions. So what the market kind of needs right now in terms of the physical, the professional industry is an event. So for example, in 2019, this section of the market we're talking about was long. And it was kind of slowly like creeping down. You could get that sense that the weight was building up on the downside. And then we had the Aramco attacks from, I guess, Houthi rebels, Iran, whatever it was. That happened over the weekend. The price spiked $10 on the open. And there was a massive rush of liquidity. They just got paid that day. Like all the macro money that rushed in basically gave the liquidity for these guys to exit. And then they were able to get short. And that's the way it goes. Or maybe not necessarily get short, but at least take profit and be out of the position. Because it is a big worry, right? Even if you're in the money, exit strategy, especially like a big position, it's a different game. You need liquidity.
If you're feeling uncomfortable that you're not going to get the big move, and then you get a move like that, the Remco, it's a gift basically.
It's a gift.
Get out of your position and walk away.
So again, this is great because now we're looking at a market that has had all the possible shocks. I mean, unless short of aliens invading, right? We've had everything that could possibly happen to an oil market, and it's just not looking likely that there's going to be another event that will cause a shock. So it's also decreasing the time you've got to run for the exit door. So
what I see as the pain trade is if the economic data continues to weaken. Again, the US economy, we're not talking about recession yet, but if it continues to weaken and those fears begin to surface, demand falls and the price action starts to drive lower, and it becomes a pain trade, and at some point stops get triggered. On a purely technical, looking at the charts, 72 is a massive level.
Okay.
And a break below there would be see aggressive move to the downside.
So Martha, this petrodollar stuff,
Yeah.
What was going on there, right? Because even for me, I was like,
So basically, the headline is that the petrodollar is dead, and that's a big deal. The reality of which is maybe not quite that true. There is a deal between the States and Saudi that expired this week or last week from the 70s, but that it's not quite the petrodollar as we know it, as what we refer to, because like the petrodollar is a market-driven decision. It's not from on high. It's not the States. I mean, it's good for them, but that it's not their decision at the end of the day. So the deal that expired was the deal for Saudi to invest in the US treasuries. So that's expired, which might make it harder to sell US treasuries. And then also this kind of links back into the recent stricter sanctions on Russia. So Russia's adopts the Chinese yuan to ruble as a benchmark exchange rate after the US sanctions force a further move away from the dollar. This is just kind of the trend we've been seeing since the 2000s, like of the like major economies anyway, of moving de-dollarization. And we're seeing BRICS want to use more local currencies. They're meeting next week, I think. They've got a meeting soon. And I think there's going to be a lot more headlines like this. So I think it's something to like be aware of, but also kind of be skeptical of the impact of, because of course like physical trading can be in whatever you want, but futures are in dollars. And so like, as we know, the futures market is huge, far but larger than the physical oil trading. So I don't think you should like, lots of people are using this to try and sell crypto. Like this is the safe haven kind of stuff. So just be careful out there.
okay, cool, thanks. So let's talk about the trade idea of the week. Who's doing that?
Yes. So the trade idea would be to go short in the Brent to buy structure. So shorting the Brent to buy boxes, because admittedly, Brent crude versus Dubai crude has seen a really strong rally over the past week. So including the July.
It's another bearish signal, right?
It
if
is.
The market is tight and strong from a physical perspective, and that's not from the Middle East, then it's as in if the Middle East is waning relative to Western, yet we've got all this oversupply in the West. It's not a great sign.
It's so you mean like for not a good sign for Middle East or for the?
If you're bullish,
you're
bullish primarily because, okay, there might be a demand story, but at the end of the day, it's because OPEC have been cutting, right? And they're continuing their cuts. So Dubai should outpace Brent. And bear in mind, obviously, all the supply increases are, like the majority of them are Brent linked in their price. So for Dubai to be actually weakening relative to Brent when all the added like extra non-OPEC supply that is coming online increasingly is not Dubai based, then it's just another bearish signal. If Dubai can't even keep up, yet that's the big white hope, then
no, I would say that yes, there's definitely it's plausible that Dubai might not be keeping up, but then I think with Brent Dubai rallying so much recently, it's come to a point where it's kind of become saturated towards the buy side, and we're expecting like a mean reversion to the downside, because right now the boxes have been correcting lower in the front, and recently the Brent Dubai rally came on the back of a few things like financial flows, a lot of refiners buying Brent Dubai, for example, buying arbitrage barrels from Western countries. That's like contributed to data Dubai rally. So that's had an outsized impact on Brent Dubai price action. I think there was also a lot of short covering flows, a lot of trade houses from our counterparty data was showing that they were very short, but then they've been getting much longer in recent days, but that's indicative of some profit taking action. And from our COT dashboard, you could see like often like shorts have always been successful in defending their positions. So they're always typically in the money, and recently price action have gone up to a level where their legacy shorts are kind of like on the money. So in a sense, we are expecting once Brent Dubai reaching a high level, we should expect more short flows to come in.
So basically what you're saying is, so the outright Brent Dubai, right? So prompts Brent versus Dubai, overly short, rush of buying, stop outs, that's dragged up on that basis, the outright. But you're saying now it's dragged up, the box is too high, and that's where we get into structure, which is, you know, the Brent spread versus the Dubai spread. So if you truly believe that Dubai is stronger than Brent, or is strong and by de facto stronger than Brent in this current environment, then that spread as an indication of physical differentials should outperform the Brent spread, which is, in a weaker environment. So that's much more of a physical reflection rather than outright, technical perspective on Brent Dubai. So you're just saying the dragged up the short covering has kind of, create a disjointed box, which doesn't make fundamental sense, which you mean reverting via the boxes, right? Or you could just outright long the Dubai spreads if you were generically bullish. But it's an interesting trade.
Yeah, that's our
cool.
That's the view.
So the poll we had last week was an interesting one because of what we've been talking about. So we had, what is the main factor in making a market hard to trade? 51% of people said low volumes. I think it's quite hard to argue with that. There's no trading where you're gonna get your liquidity from. This is kind of one of the things we were talking about earlier. But no trend was also 27%. That's also a bit of a nightmare, but I guess there are ways to trade that, mean reverting, volatility, straddles, these kind of things. 14% volatile positioning, and only 9% government intervention or organizational intervention. Which is, I think, if generic markets, I think are kind of in line with that, but oil markets, I would say interventions make it very difficult, a la, SPR, OPEC, right, at these times, when you should be expecting a repricing. Their intervention and the threat of the intervention makes things quite difficult, in my opinion. But no, that's a good one. So I think we'll leave it there because that's been quite a long one, but very, very interesting. Thanks, guys, for your time. And if you haven't already, please make sure to visit onyxhub.co because there's a lot of public available information that we've formed into dashboards, and there's a lot of analysis on there, articles written by the research team. There's also the officials by Jorge Mentepeke, the first derivatives report with daily fair value benchmarks. There's also a new episode of our leadership series with co-founder Omar Khayyam. So please look out for that. And in general, thanks for listening and see you again soon.